Good afternoon and welcome to the Fall 2023 Linneman Associates Capital Markets webinar presented by Linneman Associates and Real Estate Financial Modeling. This is your host, Bruce Kirsch, founder and CEO of REFM, provider of financial analysis tools and training since 2009. We're pleased today to have an insightful program for you, which will be presented by Dr. Peter Linneman, founder of Linneman Associates, which, for those of you who do not know, is a strategic and investment analysis advisory firm. We are using Zoom, and I would like to address a couple of housekeeping items before we get started, just to make sure everyone is comfortable. On the audio front, all of the participant audio is muted, meaning we cannot hear you as a participant, and that's by design and will remain the case throughout the webinar. If you're attending by computer, please take a moment to familiarize or reacquaint yourself with the control panel elements. We will be showing the slides, but if you would like to download them, I will put them in the chat in a moment. You don't need to have them up during the presentation because we'll show them, but you're certainly welcome to keep them for future reference. And as always, we've reserved 15 to 20 minutes at the end of the webinar to answer participant questions, but feel free to submit the questions at any time by clicking on the Q&A button, typing in the question, and making sure to send it through. If at any point during the webinar you get disconnected, simply reconnect the same way you did originally. And if you're registered later today, you will receive an email with the link to the recording of the webinar. And without any further ado, I'd like to introduce the presenter, Dr. Peter Linneman, CEO of Linneman Associates. Peter, it seems like we were just on this webinar last week, but evidently it's been 3 months.
Been an interesting 3 months. I know some of you may have heard me in the interim. By the way, we thank all of you for joining us, and thank you, Bruce, for doing it. And I thank my team. We've switched over to a little different technology this time, so hopefully it works well for everyone. We try to do this particular webcast really for our subscribers and other close friends. So thank you for your support. And in case I forget, have a great holiday season that we're about to head into. And sort of bear in mind those who are a little less fortunate and try to give them a hand as you can. With that, let's talk about the economy. And if we'll start with the real GDP slide, and I think everybody on this is familiar, but when I say real, all it is inflation adjusted numbers. You see the light green line shows a very simple pre-pandemic trend. So it's a what if the economy had just continued at its pace pre-pandemic, which, by the way, was not a very high trend versus long-term history. So, and then the blue is actual, and the red line is simply to show you where we were prior to the pandemic. And you can see we are well above the pandemic. Real GDP is around $28 trillion. However, it is still, even after this great quarter, which is a false positive in the sense of I expected growth. I expected to be a bit above normal, but we're not going to get the kind of growth rate we got last quarter on and on. I don't think we're near a recession. The reason I say that, I've been saying steadily throughout in a very simple way, is summarized by this chart. Namely, it is not a terribly high bar to keep up with pre-pandemic trend. And yet, even by that low bar, we're still about 2.7% below where we would have been if all we had done is keep track on trend. That means there's a lot of pent-up demand. There's still a bit of supply chain issues here and there. And those are still being worked through, and I'll come back to that. and I think are powerful forces that are carrying the economy forward. And you can see that if you go to the next chart, on employment, same three lines. The red shows where we were as the pandemic began. The green is what would have happened if we'd have continued by trend. And the blue is actual. And yes, you can see we are above our pre-pandemic. We've been above it for a year and a quarter, but we are still about 3.3 million people fewer employed than a rather non-aggressive pre-pandemic trend would have had us at. And it's not like there is so much different than that. Now, that means there's still a lot of room to go. By the way, the main not working here are people 62 and older, that age category. That age category has not returned to work. That age category had been a big driver of growing labor force participation, growing employment for really the previous 30 years. But the pandemic dented it. It is still stumbling around. You still have about 2 percentage points fewer people 62 and over working. And it's been flattish as opposed to upward trend. So I think that these are quite notable and consistent. And I'll just refer back, you don't have to go back as a slide, the 2.7% of GDP shortfall is interesting in that it is roughly 1 year worth of growth. So if you think about the pandemic has gone 3.5 years, we've only had 2.5 years of growth. It's a very simple way of saying it. So if you look forward over the next year or two, we would expect to get the normal growth generated by entrepreneurship and all types of growth drivers, plus this pent up 1 year that hasn't occurred. And so I think that's an interesting face to put on it. If you go to the next chart, I think you'll get a sense that the economy is still not normalized. This is the percent of industries adding workers. And the stretch of the period about 2011, late 11, through the pandemic happening, the shutdown happening, you can see that in good times, somewhere like 60 to 60% of industries are adding jobs. And in fact, it's interesting, even in bad times, you get 40% of industries adding jobs. We shot down and then shot back up to where essentially 80% of all industries were adding jobs. And you can see that that's worked its way back down, not quite to normal. So there's two narratives. The one that bad news bias puts on this is the number of the industries adding jobs is falling. Well, that's factually true, but it's actually good news. It's falling because we're getting normal. We're moving back into a normalized economy. We're even weak industries are adding jobs because they shut down. We're in a situation much more normal. And I think, again, this shows we've got good margin to go in the economy. Go to the next chart. It's the labor force participation rate of those 65 and over. The same thing would be true, I mentioned earlier, of 62 and over. But this is a rather dramatic chart in that you see that if you go back to the early 60s, the labor force participation rate of this group was about 18%. It took until about 2010 for it to get back to that. And it bottomed in around 19 86, and then began a pretty steady rise. In fact, one of the most amazing things about this chart is the financial crisis doesn't even appear on this, in that you see that upward climb 2006, 2007, 2008, 9, 10, 11. It was one of the rare data that did not drop during the financial crisis. And it shows the power of this wave. And it got to where about an all-time high of about, or an all-time modern high of about 21% of this group was working. And then you can see it dropped fast and is not really rebounded. It dropped from a bottom, but it is not really rebounded. And what's got to happen here, they're not coming back. If they left the labor force, they're not coming back. You don't come back for working a year or two. So you have to have these people who lost their jobs or quit their jobs because they were worried about their health. You have to have them kind of extrude out of the labor force. That is, they were going to retire in 2 years or 4 years or 3 years. You've got to have those 2, 3, or 4 years happen. And then at the other end of the labor force extruder, 18-year-olds come in, 30-year-olds become 34-year-olds, 40-year-olds become 44-year-olds, etc. But this is really the missing labor force. And in fact, if you go to all other age groups, they are back to their pre-pandemic labor force participation. Go to the next chart. Where is pent-up demand? And of course, it's in many segments, but I just wanted to hit some obvious ones. Medical care, lots of elective surgery, not lots, all elective surgery was effectively shut down for a year. That's a lot of cataracts, that's a lot of hips, that's a lot of knees, etc., that are backlogged and working their way through the system. In addition to that, there were people who didn't go get taken care of, their medical conditions got worse, and now they're getting cared for. Travel and tourism. Travel and tourism, if you look at travel either by hotel nights or by air traffic, what you'll find is this past summer was about 3%, 2% below the summer of 2019. So that had not fully recovered. 2% doesn't sound like much, but it is. Particularly when you realize 2019 was 4 years ago. And in 4 years, you would have expected about 2% per annum growth over those 4 years. Or to say you would have expected it to be 8% higher, and it's 2% lower. That's a 10% pent up in travel and tourism. Auto sales. Auto is a very odd phenomena. Early in the shutdown and the pandemic, people were afraid to go out and buy cars. By the time they were not afraid to go out and buy cars, supply chain issues made it very difficult and very expensive to get cars. So they didn't purchase them. They started to purchase them. And just as they started, the Fed ramped up interest rates and dampened the roughly 2/3 of auto buyers that borrow, and really put a damper on that. Didn't have any effect to speak of on the 1/3 that don't borrow when they buy their cars. So auto sales have a lot of pent up. And housing, particularly single family housing, still has a huge pent up demand. That will continue for years to come, largely as NIMBYism keeps things from being built, but it is a source of pent up demand. Now, people ask, well, how can the economy be growing when the Fed is raising interest rates so much? And I remember my Keynesian economics class that said as the interest rates go up, the economy slows. because the short-term interest rate going up discourages borrowing. Well, put aside that it's a nonsense model. You're not going to say, I'm not going to buy toilet paper because the interest rate's gone up. So the next slide is to point out huge swaths of the economy just are not short-term interest rate sensitive. For example, government employment. The Federal Reserve, a branch of the federal government, did not feel any pressure to lay people off as they raised the interest rate, nor did the Department of Treasury or the Department of Defense, et cetera. That's just not an interest rate sector. And in fact, government employment has continued to rise quite rapidly as the interest rates increases have occurred. And that's roughly 35% of GDP. So right away, you have 35% of GDP that's kind of unaffected by anything the Fed does with interest rates. Go to medical care. Well, health, medical is about 18% of the economy. And I said, there's no one who was 2 months pregnant when the Fed started raising interest rates and raised them more rapidly than at any time in history, that when it came time to deliver 7 months later said, no, I'm going to keep the baby in until rates fall. I mean, that's absurd. Or no one was having a heart attack and said, no, don't take me in. Interest rates are too high. That's absurd. So by and large, medical care is not interest rate sensitive. Well, those two sectors alone are 53% of the economy. More than half of the economy is just those two sectors. You add to it things like food and toilet paper, and et cetera, and not to mention Eagle tickets or Taylor Swift tickets, things like that, because we know those are necessities. You get a lot of things that just aren't interest rate sensitive. And in fact, my very crude back of the envelope is probably 80% of the economy is not very short-term interest rate sensitive. For example, many people don't borrow. Many people don't have loans. You say, well, the credit card loans. Don't forget, most credit card debt, a guesstimate I have, very hard to get real data, is probably half of all credit card debt is paid off in the 21-day grace period where no interest is charged. That is, people are just using it for transactional convenience, not as a financing tool. It's one of the reasons why credit card debt or personal debt in general has risen so dramatically over the last 50, 60 years is simply the rise of credit cards as a transactional mechanism. And no one goes to the grocery anymore and buys their groceries with an $8.12 check. Used to happen all the time. So most even of quote credit card debt is not sensitive to interest rates. There are some auto buyers are, but a third aren't. You have a lot of people who they locked in their long-term mortgage on their home. They're in great shape because of that. They have locked in probably 4 to 5% of their disposable income locked up in abnormally low interest rate payments on their home by historic standards. There are a lot of businesses that floated long-term debt. Now, that's not everybody, but this notion that there's a lot of evidence that the economy is interest rate sensitive is just nonsense. And all you have to do is think about it for a moment. Now, if you go to the next chart, there are parts of the economy, about 20%, that are like property development. So you've seen multifamily starts over the last, 6 months have halved. And even that is not over yet. Autos, to the extent that about 2/3 buy with loans, about half of credit card purchases, lines of credit secured by inventory and receivables that a lot of businesses have. So only about 20% of the economy is probably interest rate sensitive. That's how, in the face of huge pent-up demand and only 20% of the economy being adversely affected by high interest rates, you're seeing the economy power forward because the pent-up is dominating the interest rate impact. Go to the next and you see housing starts and auto sales in red and blue. They're indexed so I can show them together. After a little over a decade of divergence between the two, that is to say the lines essentially aren't on each other, for the last few years, they have joined up again. That's good. But they're both a bit low. And they're low for differing reasons, but high interest rates on the short end are discouraging those 2/3 of auto buyers that borrow, and high interest rates on the long end are discouraging multifamily borrowers. Now, remember again, only 2/3 of all people who buy a home do it with a mortgage. So it's not even there that everybody is affected, but it is having a drag on the economy there. Go to the next. Real brick sales that are occurring in brick retail. The good news is, versus the prior to the pandemic, you know what can't be sold online. A lot of people have tried to, they've stopped selling things that can't be sold profitably online. You can see it's at an all-time high. Yes, it's not quite all-time. That was a year and a half ago, but it's way above pre-pandemic. That's the red line, and doing quite well. It's not like brick is out of business. And in fact, 6 out of every $7 of retail, not counting auto, occur through brick still. You go to the next chart and you see roughly the share of all non-auto retail sales that are e-commerce. And you can see I put a simple trend line. There's nothing magic about the red line. It is just a trend line. And you can see it shot up when retail centers got shut, and then it dropped. And it bottomed, much as we said it would, and now it's continuing its upward trend. And so it's not to say that that will end. This upward trend does work to consistently keep industrial space demand growing faster than GDP. Brick sales roughly grow roughly at the rate of the economy and require about the same amount of space for warehouse. So you can imagine kind of a 1-to-1 elasticity. A 1% increase in GDP creates about a 1% increase in the amount of industrial space needed for brick retail. However, online sales, it's about a 3-to-1. 1% growth in the economy generates about a 3% growth in warehouse for online sales, wider aisles, et cetera, et cetera. And that means on average, and again, this is back of the envelope, for every 1% growth in the economy, you get a 1.4% growth roughly in industrial demand, industrial space demand. Or another way of saying, if the economy grows at 2.5% in a normal year, you're going to have a number like 3.4% growth in the demand for warehouse space. And until you see that supply catch up to that type of number, I don't want to put too fine a pencil on it so much as to stress the thinking. You will have demand exceed supply and industrial will stay strong. Go to the next chart, oil. Obviously, we're in a time when a lot of people have their eye on oil, given what's happening in the Middle East. This is the real price of West Texas crude. I marked the high, the low, and the red is the really long-term average since 1969. Couple of insights. One, extremely volatile. Two is that every time it goes up, there's a spate of newspaper articles saying it'll never come down. It'll continue that trajectory, and it always comes down. It comes down because at the margin, you can make too much money. And so, for example, fracking, you can make money at around $45 a barrel. And if the price is up in this range, you'll frack. And yes, you'd frack more if the administration was more welcoming of it. But still, there's money to be made, and you're seeing deals occurring. You add to that Guyana and other countries that are outside of OPEC have an enormous incentive to produce. Yes, the Saudis reduced supply. It caused price to jump. It caused inflation to jump, but obviously there's nothing the Fed's interest rate policy is going to do to bring about greater supply. That's silly. Go to the next, the Global Supply Chain Pressure Index. Basically, think of it as, is there excess demand or excess supply? If it's above the line, it is excess demand. If it's below the line, below zero, that is, it is excess supply. You can see that normally it's plus or minus 1 standard deviation bouncing around, which is to say most of the time supply and demand for most things are in decent balance, constantly moving around. You can see as the pandemic began, it shot out of sight, got up to 3 standard deviations, and then ultimately 4 standard deviations. Now, people say, well, what's that mean? For those of you who never had statistics, 4 standard deviations means we've never seen anything like it before. That's literally what it means. We've never seen anything like it before. And is it a surprise that if we never saw anything like it before, we went from, quote, normal inflation to inflation a lot higher than we ever saw because demand greatly outstripped supply in sector after sector. So if you go to the next chart, what we show here is annualized monthly inflation, annualized monthly, rather than year over year. Why? Because this gives a sense of what's happening. Now, it is volatile. It does bounce around. One of the things you can see is the blue, the all items. Several months, the annualized rate of inflation has been running 1 to 2%. And yes, it shot up. It moves around. It is volatile. It mismeasures housing. So, for example, the big driver of inflation over the last few months has been housing, which on CPI is about 42% of the index. On personal consumption expenditure index is about 18%. And they're showing 8% annualized increases in housing costs, rental cost, if you will. Well, that's absurd. Any of you in the rental market know that last month you weren't raising your rents at an 8% annualized increase. If you put that around zero, you see that, in fact, inflation is running down in the 1 to 2%, maybe 3% range. And I don't have time to go through all the data. I'm happy to cover it in question. There's a lot of different indexes to follow. There's a lot of different things to follow. But when you cut through it all, inflation is somewhere between 1 and 3%, probably 2 and 3% as we speak in true terms, and probably closer to 2 if you correctly adjust for housing than it is to 3. That's important because if you go to the next chart on interest rates, Why would you have a 5.5% interest rate for overnight lending, safe money, when in fact inflation is at its most 3%, could be as low as 2%? That makes no sense. And what it does is slow down that 20% of the economy needlessly. And that's not good, because remember where I started. We still are a year's growth behind. We should be trying to figure out ways to bring more people back to work and produce more, not less. The game here should be, from a policy point of view, more, not less. This interest rate policy is kind of crazy. The Fed raised their interest rates believing that they had an impact. But we just went through that. They don't have near the impact they think. They haven't slowed the economy, but they have distorted the economy enormously. And by the way, they also distorted, any of you who have followed me for a long time, you see that the Fed funds rate was 0 for 9 years in the 2010s. And I said that was distortionary, and that slowed the economy. That is to say, artificially setting rents, for example, too low would do harm to the economy, and artificially setting rents too high would harm the economy. And the whole thing of markets is to try to figure out where is neither too high nor too low. The Fed had interest rates too low in the 2010s, and it slowed the economy. They were starting to get them back to around the right level. The pandemic happened. They shut them to 0. They forced the long rate to 0. The inflation that occurred had a little bit to do with the Fed, but a lot to do with that supply chain issue that we discussed. And as that supply chain issue disappeared, so has inflation. Not because of interest rates, but because of the supply chain. Go to the next chart. People ask me, how should I think about cap rates looking forward? My research shows they're mostly driven by capital flows, not interest rates. But let's just do some thinking. Capital flows have dried up. They dried up because the banking model got turned upside down by the high short-term rates, negative slope yield curve, because it said they had to get all of their return from the credit spread because they were getting none of it from the yield curve. And so it's not surprising that as lending dried up, exactly as we predicted, cap rates went up. They didn't go up as much as you think because transaction volumes are way down. Transaction volumes are way down because bid-ask are huge. And a way to think about that, by the way, is we get to see 20% of sales. If we're getting about 20% of normal velocity, we're getting to see the pricing on 20% of the assets, but not on 80%. On the 80% we're not seeing, the owner is buying it back from themselves. And what we really would like to see is what's the cap rate they're willing to pay themselves to buy it from themselves. And you know it's a lot lower, or they'd have sold it to someone else. And so my gut is for real, unless you need to sell, you're an inheritor, you have a 1031, you have some type of estate issue, some type of forced sale, then the cap rate you see is the cap rate. But for everybody else, that's not the cap rate. It's much lower. Capital markets always normalize. No matter how bad you think capital markets are, give them a year or two and they normalize. So crudely, the short rate should be the rate of inflation, let's say 2.5%. I'm being on the high side, plus about 50 basis points premium. So the short rate with a 2.5% inflation should be about 3%. The long rate should be inflation, about 2.5%, plus about 150 basis points. And you end up at 4%. kind of was where the long rate should be. So you can get a sense that the short rate is right now probably 250 basis points too high. The long rate probably 80 basis points too high. The cash flow cap rate on real estate you could think of intellectually as being the long rate plus about 225 basis points for risk, more for lower quality properties, less for very high quality properties, plus about 50 bips for illiquidity. But remember, the cash flow cap rate plus appreciation should be the target return that we just said. So you need to take off the anticipated cash flow growth rate, which is if you have a 2.5% inflation, is about 3.25% per annum. So that says the cash flow cap rate should be around 3.5% today. Or should be, given the inflation fundamentals at 2.5%, should be around 3.5. That says the NOI cap rate, adjusting for the gap between NOI and cash flow, probably 4.3%. That was with a 20% differential between cash flow and NOI. If you have bigger, has to be higher, like for office. If you have industrial, lower, because there's not as much gap between it. But it's a nice little discipline metric to think about. Just a couple of things and then we'll wrap up. Next chart, cumulative shortage of multifamily housing. We are about 370,000 still short over the last 20 years of the amount of housing needed, multifamily housing needed to keep up with demand. 370,000 out of about 44 million. So that's versus a peak of 1 million in 2014. So that's gotten down to pretty good balance, which is to say some submarkets are in a little bit excess supply, some are about right, and some are in short supply on the multi side. If you do the same thing, the shortfall of single family, the next chart, from 2002 to 2006, we way overbuilt. That was the housing bubble to the tune of almost 2 million homes in 4 years. And then we shut down production. And you can just see the shortfall building, at first because of the fundamentals and ultimately because of NIMBYism. We're running about a 3.5 million shortfall on roughly 90 to 95 million units. So around 3.5% shortfall in single family. That means single family prices are going to continue to rise in real terms, maybe not every month, maybe not every quarter, but fundamentally over time, as there is excess demand because NIMBYism and these phenomena are keeping it that way. This is probably the best single thing going for multifamily because single family is the competitor. And if you have to save longer before you can get your down payment to move to a single family home, it increases multifamily demand by a couple of years for the typical renter. Real quick, Bruce, before I wrap up, next chart, office vacancy rates. Office markets are frozen by and large. It's not even clear how relevant these vacancy rates are, but it's fair to say the office market is frozen, which is like past times when it's been a difficult capital market, where the capital market was in trouble and the property market was in trouble. So in that sense, office is typical to past downturns. Yes, the fundamentals of it are a little different, but if you go to industrial, you have a very different scenario. Here, rent and occupancy are in very good shape, still kind of all-time good shape in terms of rent and occupancy. It's the capital markets that are the problem. So all you need there is for capital markets to adjust. You don't need time for both capital markets and rent and occupancy to adjust. This is very different than if you look back at, say, 2010 or 2003 or early 1990s. There were situations where vacancy was high, the property side was in trouble, and the capital side was in trouble. Here, only the capital side's in trouble. Very different scenario than the past. Go to the next, retail. Same way, retail vacancies have come down. Good retail is doing pretty well. It's hard work. But this time, the capital markets are stressed for retail, but not so much rent and occupancy for the better properties. Again, a very different scenario than 2010 or the early 90s. Very different scenario. I don't think most people have grasped that. And then go to hotel. You've got hotel occupancy. We could also do RevPAR, but I just wanted to do occupancy. Again, occupancy here is pretty good. It's not fully recovered, as we said, but it's pretty good. Notice during the financial crisis where it was, notice where it was after 9/11, notice that it had fallen in the early 90s. So again, the capital market is a problem for hotels, but not so much rent and occupancy. And then go one more, multifamily. If you look at the vacancy rate for apartments, it's quite good. Again, capital markets are stressed, but not the rent and occupancy. And that contrasts. If you go to the early 90s, you had vacancy high and capital market stress. Go to early 2000s, the same way. You go to the financial crisis, you had high vacancy. So this is a very different scenario for everything but office. In the past, when you had, quote, times like this, it was both rent and occupancy and capital markets that were in disarray. This is basically a capital markets in disarray with the exception of office, which is in disarray. And the last thing I'll end on is a chart. We get asked a lot about US government debt outstanding. This is as a percent of GDP. It's big. I'm not trying to, and I'm not saying it's the right number or the wrong number. I'm trying to provide perspective. The blue is essentially the headline number as percent of GDP, which is over 100% of GDP is outstanding in federal debt. If you strip out debt that the federal government owes to the federal government, that is to say, one branch of the federal government holds the asset and the income stream claim on the debt, and the other holds the liability and the payment of that debt. It's classic intra-company debt. If you net out intra-entity debt, you get the red line. And the red line says, yep, our debt as a percent of GDP is up. It's up notably versus, say, 2007, but it's like 60% of GDP, not 110% of GDP. That is to say, a lot of the money owed is owed to the government. So it would be the payer and the collector. It is the payer of the interest and the recipient of the interest. So it nets out. So the red is the more relevant line. The problem is not, is it high or low? The problem is, are we getting our money's worth on things the government is spending on? Think about it this way. If you think about GDP as a crude metric of our income, how many of you could pay off the debt on your buildings with 7 to 8 months of income, 7 to 8 months of income paying off all the debt on your property. Well, that's essentially the US's situation. We could pay off the entire debt if we said, okay, for the next 6 or 8 months, all the money goes to pay off the debt. We'd never do that. But the debt itself is not high. We're just not getting our money's worth. And what it also is a reflection of is people want somebody else to pay it. I want the future to pay it. I want you to pay it. You want me to pay it. So politically, it's an issue. And then the last line, the lowest line is, this is debt held by foreigners, true outsiders to our system. And you can see, interestingly, that's gone down over time, over the last decade, actually fairly notably. So the money we truly owe outsiders is not so dramatic, and is not so dramatically different than in the past relative to the size of the economy. The big one, though, you just have to adjust, if you're at all subtle in how you think about these things, the intra-company debt. So I'll end by saying no recession before our next call. I'm the one who, it's funny, I read these articles and they say economists are surprised at the strength of the economy. Any of you have listened to me, I've not been. They keep saying economists are surprised at how inflation has come down. Nope, not me. I think you're going to see inflation continue to moderate, and you're going to continue as supply chains even further adjust, and you're going to see the pent up outweighing the Fed needlessly keeping interest rates at distortionary levels. Last thing I would say is, so how does the banking system get back on its feet? My friend Sam Zell famously said in late 1991, when both property markets for all categories of real estate, rent and occupancy, were in trouble, and the capital markets were in disarray. And Sam famously said, stay alive till 95, saying in the 3 years, things would adjust. In a funny way, as an homage, I would say, stay alive to 3.5. And when the Fed comes to their senses and says, look, inflation is probably 2%, where there's no reason to have the interest rate where it is, and they reduce it to 3.5%, you'll have real slope on the yield curve. The banking system will be back. Growth in the economy means new deposits in the bank that will drive lending. So stay alive to 3.5. And with that, Bruce, I'd end.
Okay, great. Thanks so much, Peter. We had several participants write in regarding the impending office defaults and how those are going to potentially impact the broader lending market. Do you think that lenders have a good sense of their exposure? And what have they done to protect themselves, or what haven't they done?
Well, I think the first thing is they're still figuring it out. A lot of the buildings are still cash flowing. If they have low leverage, they have 2, 3, 4, 5, 6, 7 years to go on their loan. If they have relatively low leverage, they're still cash flowing. Yes, they're not cash flowing as much as occupancy gone down. And so lenders are trying to figure that out. If the loan is due, you have the problem of what is a building where there's no bid for really worth. You're seeing some wealth individuals buying stuff, but not much in the way of institutions buying things. It's an out of favor category that way. I think the most important thing to bear in mind is, I just had this number the other day, that the debt on office buildings is a fraction of what it was on single family when single family became a big problem in the financial crisis. And therefore, I don't think it's nearly as systemic as an issue as was the single family. Also, remember the single family, you had people doing 1 to 3% down. That's not been the case with office. Office had 10 to 40% cushions of equity. So it's an issue. It's an issue that essentially people are pushing out, trying to not solve, if you will. But it is an issue. I don't think it's a catastrophic issue for the market.
We did have several individuals request clarification on your new little saying there, stay alive to 3.5. We have some confusion. Does that mean inflation, the short rate, the long rate? What 3.5
The short
are you
rate.
talking about?
The short rate. The short rate at 3.5. If tomorrow the Fed put the short rate at 3.5, you'd have no particular change in inflation. Remember, we had the short rate at 0 for 8 years in the 2010s, and we didn't have any problems with inflation. So the notion that they're achieving a lot by high interest rates, as we talked about, is just fantasy. And so if they tomorrow drop the short rate to 3.5, they won't. They're too stubborn, and they are using a kind of crazy model that's never worked. But if they drop the short rate to 3.5, you would see the capital markets quickly come back into functioning.
We had several individuals also asking, beyond what you just said, what other triggers might precipitate an acceleration in the flow of funds into CRE?
I think the main thing is people forget that growth, not just in the US, but growth, economic growth, generates wealth and generates deposits at banks. And so every day that we grow, there's more cap. So imagine today that we had no extra money to invest, literally, right? We had no extra money in the system. And then we get 3% growth in the coming year. That 3% growth has got to find a home. That is to say, that wealth created, that liquidity that got created in deposits has to find a home. So don't underestimate how growth alone resolves capital market situations. And a year or two of growth goes a long way. Think about it. You get 2 years of growth at 2.5%. That's 5% more money that's got to find a home.
Multiple participants have written in with the comment that you seem pretty optimistic, and that's generally the case with you, Peter. So what concerns you?
Well, I think, let me just take the optimism first.
Okay.
I think that if you're investing in real estate, it's not a trading asset. You're in the business of predicting what's going to be happening 5 or 10 years from now, not so much predicting what's going to happen tomorrow or next week. Now, if you're a hedge fund trading US treasuries or currency, at leveraged levels, you're in the business knowing what happens tomorrow. So it's one of the reasons I'm fundamentally, people say optimistic, is I view real estate as a long-term investment. I look at the US economy, and with rare exceptions of particular submarkets, it's a growth story. It's a growth story over my entire life, with the exception of particular submarkets. But remember, if it's a growth story in general, except for particular submarkets, it's really a growth story in other submarkets. So I don't view it as optimism. I view it as empirical realism, that if you're in the business of long-term real estate, that it does look good. And one of the things I try to drive home is, don't get confused by the shiny objects. I've done a fair amount of research on this. The returns you're going to receive over a 7 or 10-year hold have very little to do with what's going to happen tomorrow or a week from now or 10 days from now or even 3 months from now. It has to do with what's going to happen over the next 10 years. So that's one reason. Then the second reason for the optimism is, again, I don't think it's optimistic. I think it's realistic. Namely, pent-up demand is real. It's very real, and people are trying to get back. And you add to that, the Fed has distorted the economy again, this time too high of interest rates, in the 2010s too low. I think they'll eventually come to their senses, and that 20% will do better and make up some of the gap and power forward. I'd have a different feel if that first chart of where GDP is at, if we were way above trend, I'd say, hey, we can't grow at that rate forever unless we found new productivity drivers. So I just think that people accuse me, I guess, of always being optimistic. I don't, on this basis, view it as optimistic. I view it as empirically realistic. And I try not to be distracted by the shiny objects, like who's going to get elected and who's going to do this, and are they going to support birth control. Now, that's important for social issues, but it's not important to this longer term driver of the economy, which is what I focus on.
Thank you. From the development side, we've had multiple participants inquire about what you expect as far as construction cost pricing in light of the reduction in starts. What do you
Well, there are two things there. The one is that chart on supply chain issues. The construction products, the building products, was one of the hardest hit in that regard. And so the fact that we've swung from this massive excess demand, even though demand wasn't that high, to a bit of surplus means that for materials, construction costs already have moderated. I think they'll moderate more. The labor side, as you saw, we haven't got labor fully back. So the labor side is still a bit tight, not as tight as it was a year ago, but still tight. So the labor side is pushing upward still. The non-labor side is pushing downward on the construction cost side. Yeah, I think that in net, it's a downward slightly, which means in inflation adjusted terms, it's down in real terms, but probably not nominal terms in the near term. And then the cost of money is the big issue at the margin.
Great. Well, thank you so much, Peter. As always, highly insightful. And unfortunately, we're not going to be able to get to all the questions that have come in, but I want to make everyone aware that this presentation is a digest of what's presented in a lot more detail in the Linneman letter, which is a quarterly subscription from Linneman Associates. And you can find out more about that at linnemanassociates.com. As a reminder, if you're registered, you will automatically receive an email later today with a link to the replay of the webinar. Peter, thank you as always, and early happy holidays to everyone. And we will see you back in February.
Thank you.